We'll go live now. Good afternoon, everyone. Welcome to the session on taking stress out of distress by IVCA and IC Universal Legal, a discussion on rescue avenues for stressed assets. Today, we have Jyoti Rai, Chief Business Officer at IC Universal Legal, as the moderator. With over 2 decades of experience, she has served across segments of the Indian financial markets, from banking, asset management, custody and clearing, consulting, and offshore advisory. I now hand over to Jyoti to do the context setting and introduce the panelists.
Thank you, Shreya. I will take it from here. Hello and good evening, everyone. Welcome to IVCA and IC Universal Legal hosted interactive session, Taking Stress Out of Distress, a discussion on rescue avenues for stress assets. Yes, I'm Jyoti Rai, your moderator for this session, and I'm personally thrilled to be moderating such a brilliant panel of ACE professionals in the Indian distress space. Before I start the discussion, I'll set some context. As we all know, the harsh impact of pandemic led to contraction in global GDP, and India was no exception, as we saw our share of tightening of credit in the banking and NBFC sector, leading the credit markets to a difficult and rough patch, driven dramatically down by the COVID-19 shock, and then revived by a massive policy response. As we meet today, companies are looking to repair the damage inflicted by the pandemic, and coming to their rescue are ARCs, alternative funds, special situation funds, and so many. Post the introduction of the Insolvency and Bankruptcy Code in 2016, we have witnessed private credit picking up and playing a pivotal role in infusing much required liquidity in the strained balance sheets of companies. So much so that reformers, regulators, and seekers are calling it a solution capital, most necessary at this point. It's not too far to call it distress investments a lifeline capital for revival of so many businesses impacted by either credit crunch or due to stress out of business contraction. Trends documented by global leading players in this space have confirmed of investors fleeing low yield public credit market in favor of private debt. On one hand, we see investors seeking returns. On the other hand, the investments are helping in rebuilding, restarting the economy. So, new capital to deploy, a rebound of economic activity, post-vaccine optimism, and improving business prospects. Lenders, it seems like lenders are gaining confidence and borrowers are getting improved terms. Our panel of speakers are leaving no stone unturned to direct flows from global capital allocators into India's distress space, which is a formidable opportunity in the making. Each one of our speakers are doing their bit to put India on the global map. Let's discuss how each one of them are doing their bit to ease the stress in this distress segment and what will be the top trends in 2021. Joining on this session is Shantanu Nilavadi, Managing Director, India Resurgence Asset Management. India Resurgence is a distress fund that focuses on purchase of distressed assets and underlying debt from the large NPL market in the growth sector. Prior to India RF, Shantanu was the co-head of Structured Investment Group with Piramal Enterprise, and before that, he was partner with the New Silk Route Advisors, a private equity fund. Across these responsibilities, Shantanu has spearheaded a well above $1 billion of asset under management.
Thank you, Jyoti.
Yeah, so that's our first speaker. The next is Indranil Ghosh, Managing Director, Cerberus Capital. Indranil was brought in from Aon, the India Special Situation Fund of Apollo Global and ICICI Bank, to head and lead Cerberus office in India in 2019. With more than 19 years of investment experience in India, I think Indranil has serviced a lot of segments across Indian financial markets. Indranil has led and managed investments across capital structure in a wide variety of businesses. Indranil has also served at Citigroup Venture Capital International, where he was involved in the growth equity investing across industries and was responsible for management of Indian portfolio companies. Hi, Indranil, thanks for joining us.
Thank you, Jyoti. Hello, everyone.
Coming to our next speaker, Rahul Chaparwal, Executive Director, Kotik Special Situation Fund. Rahul has been with Kotik Special Situation Fund since its inception and played a very pivotal role across all facets of his operation, including investor interaction, deal origination, investment, and asset management. Rahul has more than 16 years of diverse experience across alternative asset investments, debt capital market, and management consulting. Rahul has been part of Kotik Group for the past decade, and prior to that, he has worked with CRISIL and AF Ferguson Consulting. Thanks, Rahul, for joining us.
Thanks, Jyoti.
Joining us is my senior colleague, Nitesh Tiwari, partner, IC Universal Legal. Nitesh has been with the firm since 2013. He's a member of the transactional practice team, focusing on assisting and advising domestic and foreign clients on banking, finance, and debt capital transactions in India and overseas. Nitesh has advised and assisted various mutual funds with their investments in structured and vanilla debt products across diverse industry sectors and non-banking financial institutions in high-value lending transactions. So, coming to our panel discussion, for the audience, I'll clarify that the panel discussion is classified in 4 categories. We have questions ranging across 4 categories. First, to begin with, will be generic questions. Then we'll move into the heart of investing, opportunity and challenges, where we'll cover investments, price discovery, exits, and so on and so forth. We'll move to the regulations and discuss as they are and what is the wish list from the regulator. Last but not the least, we will certainly be covering up bad banks in this discussion. Audience can place their questions in the Q&A box. So let's start. My first question is to you, Shantanu. As we see, distress in corporate books have gone up. Rescue mechanisms are being written. Private equity too has started to invest in this space. Can you please enlighten us, which are few major factors that is attracting all these global asset allocators into India? Directly or indirectly through vehicles that all of you have set up, in spite of the nascency of the market. What are your views, Shantanu?
Thanks, Jyoti. So let me start with saying the one big attraction is the size of the Npl opportunity. You must have read that the current Npl is about 10%. RBI is forecasting that with the COVID-induced pain, by September, this will go well up to 15%. So that's give and take approximately $200 billion. In this bucket, if you add potential stress, so if you look at many corporates, you pick up any balance sheet today, you'll see a lot of corporates have interest cover, which is less than 1 for the last 4 quarters. So which means that it is near stress. There are failed restructurings, which are there. You put all of this in a bucket, you could take out the retail stress. In our view, the size of the addressable market, what gets left behind, which we call as a corporate stress, is close to $150 to $200 billion. So the sheer magnitude of this market attracts attention. I think the second key differentiator when we talk to international investors who are looking at India, invested in various funds in India, is the India stress is remarkably different from other markets, say like Europe, where there is a flat GDP growth. The focus is more on recoveries. While in India, as you know, GDP may grow at 10% given the pent-up demand and over time settle at 5 to 7%. So the focus is more on resolution and turnaround of assets, where it's actually possible to get equity-like returns. So if you keep both these buckets, these key points in mind, I think what global fund managers are finding are that many assets in the NPL bucket across diverse sectors, take it from infra, industrial, exports, consumer, that are well positioned on competitive landscape on cost quality, but are largely underperforming because of external market reasons, balance sheet stress, fraud, and so on and so forth. So I think the way the fund managers look at it, the investors look at it, is if you can turn around these assets on the back of recapitalizing them, doing an operational turnaround, put them back to use, good use, generate employment, then on the back of a steady demand growth. And we should keep in mind that when you do a demand supply, there's not much supply coming in the future, because if you look at the micro markets or India in general, corporate balance sheets are levered. Greenfield projects are becoming tougher because of land acquisition, approvals, and so environmental reasons. So you can see that these assets can be well placed on demand supply, where utilization can go up pretty quickly, and so as profitability of such assets. And I think the way to always look at it is give real examples. If you think about the steel sector, there are a bunch of assets which are in the dirty dozen: Bhushan Steel, Bhushan Power, Monet, SR. As you can see now, once these assets in in the resolution period itself, when further liquidity was infused and then strategics took over, whether it is GSW, Asymmetry, Tata's and so on, and are partially backed by a strong commodity cycle, all of these plants are operating at optimal utilization with industry-best ROCEs after decades of not operating profitably. So I think that's really that opportunity which attracts it. We ourselves in our portfolio have seen, assets where profits have grown by a figure of 40% over the last 3 years. So that's really the key attractiveness, I think, for foreign investors insofar India distress is concerned.
Thanks, Shantanu. That helps. Indranil, you've been out on road shows. You've been interacting with global investors. What is your view? What's bringing them to India?
I think Shantanu covered a lot of it, but very simplistically put, India is one of the last few bastions of yield, right? Globally, especially, post-COVID, with central banks acting the way they are, there is hardly any yield to be found. And even for stressed and distressed situations in the West, right, in Europe and the US, returns are fairly low, and which basically has piqued investor interest in sort of a large economy like India, whereas Shantanu mentioned the macro works really well, and obviously we've been going through a little bit of a phase where there has been turbulence as far as the economic growth is concerned, GDP growth is concerned, but that's going to be back on track pretty soon. And given the macro, given the fact that there are reasonably sized businesses here that one can look at, even with the stressed and distressed lens, and that you can make, a fairly decent mid-teen type IRRs is what sort of interests global capital allocators. And that's one of the primary reasons why everyone who looks at the stress distress space is present here in India at this point of time.
Right. Thanks, Indranil. Rahul, what's your view? You have done a successful closure of the fund and you are going to hit the road with the new. What do you sense when you are speaking to global asset allocators? What they are liking it in spite of nascency in our regulations?
No, so first, a slight correction. We've closed the fund in terms of got the investment, but we have deployed only half. So it's still some time for us to go and hit the road for the second fund. Having said that, I quite agree with what Shantanu said in the sense the size of opportunity is humongous. Even basis current NPA stack, current outstanding debt book, the total stack of debt is NPAs is around 130 billion USD. And, out of that 70-75% is provided for. And if you go by typically the way banks look at it, obviously this is spread across retail loans, infra, everything. And typically, conventionally, what we have seen is that, the banks, the conventional banking system, if they're provided for it, they're happy to sell it. So to that extent, it increases the possibility of closing out a deal. And added to it, the COVID-induced stress is going to further increase it. Having said that, probably, NPAs, India has gone through those, spikes in NPAs and then come down and stuff like that. What is very distinctive this time around is, whether we like it, whatever we say about it, the IBC, while the efficacy of the regulation has, in terms of resolution to turn around or to resolve asset, has been higher than what it was envisaged to be, but still it's a very potent tool in the hands of the lenders. And I guess that puts a genuine threat in the minds of the defaulter. And that also should be exciting, I believe, a lot of these investors to look at India opportunity set with a positive mind frame. So the opportunity set, the regulation, and the fact that India, all said and done, is going to be one of the highest growing GDP countries. So that talks about the future growth potential for these companies. So I guess these should be the exciting factors for the investors.
Thank you, Rahul. And thanks for the correction and wish you best for the deployment and further fundraising. And I think, yes, all of you brought out some very good points, and it's not one, but several compelling reasons that are in favor of India today for these asset allocators to start cutting their check and, giving to all of you to further invest in Indian markets. We have a question coming on IBC later, Rahul, so I will definitely pick that up. But we spoke about steel sector. Shantanu mentioned about steel sector in distress. My question to you is on by very nature, these distress funds are probably sector agnostic. But is there any sector in particular you think that will bring out opportunities? So Rahul, my first question is to you.
Sure. Interesting one. So let me quickly take you through what we have done and how we look at situations, right? Ours is $1 billion fund. It's a sector agnostic, as you rightly said. It's a product agnostic. We can do debt, equity, and we can do everything that falls between debt and equity. And to that extent, I think we have been lucky to have got around 7-8 opportunities in the last 2 years. And we have deployed across the sector, maybe steel, cement, pharma, real estate, infra, everything. Now standing here, how do we look at things? I think, while there is opportunity all across the sectors, probably sectors which excite us as a fund house, and probably which is where we could see there could be significant amount of stress is basically the contra bets, I would say. Probably we have seen a lot of pain in hospitality, hotels, the industrial segment, which saw a demand plummeting or dropping significantly. But if one were to fundamentally believe that India is to bounce back, the growth story is intact, then probably these are the sectors which have bore the major brunt of it, would pull back pretty well. And probably we are pretty excited about these sectors. Having said that, fundamental sectors like pharma, chemicals, where we have distinctive edge, certain global changes, certain shift of demand, shift of manufacturing hubs, where India is expected to benefit, that also excites us. So probably if I were to summarize, we are pretty excited. We would be very keen to explore opportunities in hospitals, hotels. Might sound bizarre to some, but yes, we are looking at it. Industrials, chemicals, pharma. Yeah, these are the sectors we'll be very excited. And I think there could be a significant set of opportunities coming for all and everyone in these sectors.
Interesting. Hotel indeed was a distinctive sector. Yeah. Shantanu, coming to you, how does this resonate? This entire aerial dashboard of sectors prominence. How does it resonate to you? Which are the sectors that you think will bring opportunities?
Yeah, I think the way we approach this whole distress space is we broadly track around 15 sectors. And needless to say, these are more capital intensive because that's the reason there's stress. And we put it across, so we do a industry top down and bottom up on specific assets. So there's a two-pronged approach. I think the first is on the top down. So we put industries across broadly to oversimplify it in 3 buckets. One, what we call as the industrial infra segment, where fundamentally we believe that these are capacity constrained sectors. So not much capacity is coming. So if you look at a sector which Rahul mentioned, like cement, if you take the last 15 years history of India in the cement sector, it grows at a multiple of 1.1 times GDP. And if you see amount of capacity which came over the last 15 years, and given the change in the cement, limestone mining rules, we think that if you get an asset which is well placed on cost curve, has 40 years of mining reserves, and the demand is always going to be there. So if GDP is growing at 6 times, this will go at 6.6 to 6.5 times. So that's one bucket we actively look at. The second is the export market. India continues to be attractive on cost quality on segments like chemicals, auto components, textile. So again, that's a sector which really interests us. And the third is a domestic consumption story, where it's building materials, similar to Rahul what said, hotels, hospitals. So we typically try and avoid asset light models where there's not much collateral. So EPC would one sector which we would typically not look at. But unless we believe that the entry barriers are strong, and hence reliance on customer lead, vendor codes, if it's an auto component business, or cash flow generation is what then we would typically rely on. But otherwise, it's largely asset-backed, capital-intensive sectors which we look at.
So interesting. The domestic consumption story was definitely a new sector, so to say, that we heard from you, Shantanu. Coming to Indranil, to you. You heard Shantanu and Rahul speaking of their dashboard of investment style. How does this resonate with you? Where are you looking?
Yeah.
Which sectors are you looking?
I think it all makes sense. One sector, in addition to what they've been saying, and parts of it was mentioned, would be real estate for me, right? One of the trends that we are increasingly seeing is real estate, especially the residential real estate, has very few avenues to get capital, right? Previously, there were the NBFCs who were lending for construction finance. There were certain mutual funds which were making capital available. All of those pools have kind of dried up, and every single NBFC out there is sort of, other than maybe HDFC, is looking to sort of reduce their exposure to what they call as CRE. So we think that will be a sector which obviously already has some amount of distress which can be addressed, and going forward will continue to provide opportunities given given that that sector needs a lot of capital and isn't getting access to much of it at this point of time. So that's one additional sector we feel strongly about.
Understood. No, thank you. This really completes the whole aerial dashboard, as I said, of sectors that are rolling out opportunities as we see. And since we're talking about investment style, my next question is in continuation of that. While each fund has its own strategy, they have their own analytics that they run. Credit assessment is unique. Risk recognition criteria unique to each fund. Which is that single most integral factor, Shantanu, for you to even consider or evaluate a potential investment? So the question will be rolled to Rahul and Indranil as well. Shantanu, first, you will go in sharing with us your most integral factor for you to consider and evaluate a potential investment.
Thank you. As you can see, evaluation is complex because there are a whole lot of sector-specific challenges, but I'll try and keep the script simple. So this is what we believe in, is basically we want to look at good businesses with bad levered balance sheets, where we think that there's an opportunity to settle the debt or the EV at a lower cents to dollars, which is typically a discount to a replacement cost or a DCF. Then we look to recapitalize the balance sheet. So it just doesn't end with a financial engineering, but recapitalize the balance sheet with the right mix of debt and equity, whether it is fund working capital to revive the business, or it could be CapEx required for turnaround, such as maintenance, last mile, efficiency CapEx, so on and so forth, or growth investment like diversification and expansion. And further, equally important is invest in talent, systems, best practices and processes, so that the asset moves back into top quartile in the space it is in, to be competitive, and eventually move the asset, as we say, from a non-performing to a performing credit, where debt attachment points start coming down, rating upgrades happen. And if all of this is achieved, eventually it will lead to a growth story, and which in turn will allow us to make equity-like returns. So that to us is the simple mantra, be it any sector, any asset we look at.
Right. Would you also be differentiating on the due diligence process adopted? Will that also differentiate fund to fund, Shantanu?
Yeah, it depends how you're looking at it. So in our fund, we would typically target a higher IRR. So there'll be, Rahul did mention about the fact that, funds are looking at equity. So when you start looking at equity and you're looking at higher returns, you're not just looking at collateral value and debt service cover ratios, loan to value ratios. You actually, because equity is going to stay there for 5 years before you get your returns, you got to do a long diligence on how the sector will look like, what would be incrementally be required for that asset to move, not just to a better rating, but eventually to move to an equity-like story, so that to get equity-like returns. So diligence would be, I would say, just like a buyout would do in the private equity space. It would typically be that. So it would cover, in addition to the normal financial, legal, commercial diligence, forensic. We give a lot of importance on environmental diligence in terms, so that would be other area we would focus on.
Excellent. Moving the needle to Rahul. Rahul, what is your, in your scope of things, which is the most integral factor for you to consider while investing, making a potential investment?
Yeah. So Jyoti, if I were to talk from the perspective of my fund, ours is a distressed stroke special situations fund. So something which has distress, semblance of distress, or something which just gives us opportunity to plug our target return. That's our target segment. So when I look at anything of this sort, and largely going in, typically we would want to work with the promoter, or if you're working with the promoter, that's the only deal. For us, the guiding principle is the profile of the promoter. Is it someone I'm going to be comfortable working with? So that smell check is very, very important for us. If that doesn't pass through, we would would have no issues about saying no to it. Obviously, then if someone's coming to us, he would have a debt stack which is not in sync with the cash flow generation, current or future. But as Shantanu said, he has to be having a potential to be to a situation, where probably the cash flows and the debt talk to each other. So here our guiding principle is basically the sector which that entity is present in, and where is its relative standing now, or probably my perceived understanding of his standing down the line once I correct it.
Okay.
Obviously, then we go into normal things like the sectoral exposure, which we spoke about. What is the domestic consumption vis-a-vis export? And obviously, it has to sail through the diligence. It has to be ticking all the boxes right on the diligence front. That's a way.
Understood. No, fair point. Absolutely. Indranil, coming to you, how do you look at these potential investments?
So I think most of the points have been covered, but from our perspective, especially when we are looking at a transaction which is more credit in nature, and there could be some equity upsides, but effectively your outcomes are going to be mid to high teen IRRs. It is very important that our underwriting is able to establish that we won't lose principal, right? So the price at which we are buying at, and for it to be super solid in terms of being able to cover at least our cost is important. And that's how we sort of focus on transactions. And that's how we narrow down on businesses and assets, which are either, fairly have a lot of potential in their respective niches, and while they might be struggling right now due to want of working capital or other reasons, with the capital structure being fixed, they should be able to bounce back and be fairly in the top 3, 5, 10 in their respective niches, right? So, or we are buying something, as I think Shantanu and Rahul both mentioned, where just building that asset is no longer possible, right? A very marquee piece of real estate or cement, which I think everyone on this panel has either invested in or pursued, because it's just difficult to recreate these plans and get these limestone concessions. So those are some of the filters that we put in, but effectively we want to own a significant chunk of the cap stack for a business which has the potential of being one of the leaders in their individual niches, if I were to summarize it.
Right. No, thank you. This really helps. I'm picking up one important aspect, and Nitesh, this question is to you. It's a mixed question, a complex question. It's about the due diligence. Is it easy to conduct a due diligence on a company that is distressed, especially the one in CRP process? And do you see information asymmetry, how prominent it is? And what tools do you employ to overcome the same? Nitesh, question to you.
Thanks, Jyoti. I think the short answer to both questions, I think the first one would be no, it's not easy. And the second one would be yes, there is a lot of asymmetry. See, I remember reading a report when the Bankruptcy Law Reforms Committee was formed. I think they'd put out a report on the information asymmetry that exists and the correlation between information asymmetry and the time taken for resolution. But this was in respect of the erstwhile regime under BIFR. So, I mean, you'd be stunned to know that from 1987 to 2014, whatever cases were filed in BIFR, 50% of them took 5.1 years to actually proceed. And the remaining 50% cases were never resolved up to 2014 till the case, till IVCA came into being. So, yes, there is a lot of asymmetry, and the information that actually trickles down from the promoters is actually very, very difficult to come by. I think the genesis of the problem lies in corporate discipline. I think when I say corporate discipline, I think there's a culture of not, maintaining records and not maintaining compliances in a timely manner, to give you a situation, let's say, even in ordinary transactions, which are non-distressed transactions, we end up undertaking due diligences. Even in those circumstances, at times, information is either difficult to come by or information is documented only just before the transaction. So imagine this in an IBC situation now. The promoter is already an ex-promoter. Okay, the management is ex-management and they're already hostile to you, right? For them, there is actually very little incentive to actually give you more information, although they're legally obligated to give it to the IRP. Now, IRP, poor guy, is a conduit between all the stakeholders. So whatever is the IRP's handicap is going to be your handicap. So there is a difficulty. There is a lot of difficulty in the information coming to us. Having said that, I cannot actually, overstate the importance of, clear and indisputable nature of information, because I think that helps investors, and the panelists obviously are investors, so they will know better. That helps investors not only discover the fair value, but also preferential transactions, undervalued transactions, etc. So the answer, like I said, there is information asymmetry. Now, coming to tools, I think, like I said, if there is a strong culture of maintaining good governance, that is half battle won for any investor. I think other than that, we could look at the public repositories that are there. There is information utilities, and now it's a mandatory requirement under IBC. There is CERSAI, there is Acrylic. All of these repositories hold a lot of information. And in addition to this, I think lastly, I would say that in information technology, IT and technology can be employed to actually, introduce seamless flow of information. A lot of data now is now in virtual data room, and I think that has become very easily accessible, and it's been very helpful to investors to actually sit and do diligence from wherever they are sitting, right? So that's been very helpful. I think I could end by saying, obviously there are both senior panelists here and they know better, but I could just end by saying, it's good to be duly diligent than to be unduly taken advantage of. So.
Yes, no, thank you, Nitesh. On that note, Shantanu, what's your view on this information asymmetry and what Nitesh's view was with regards to due diligence in the stress company, which is really not that straightforward?
Yeah, I think, let me start with saying that there is a difference in the access to information depending on whether it's in IVC or not in IVC. So the reality is, if it's outside IVC, whether you're backing the current promoter or you're settling with the current promoter, the access to information is relatively better, while in IVC it is completely hostile. So let me just take the more hostile situation, which is something we went through when we bid for Binani Cement and Bhushan's. You may recollect that those are the first of the IVC. And a lot of us came with a private equity and credit background, but we never expected that there will be no information flow available to us, and hostile environment. So I still remember some of the team members had gone for a site visit. They got threatening calls. We had to hire security guards and so on and so forth. So I think the way I would look at it is, firstly, I don't think we rely on the books and accounts. So that's point number one, because whatever it is, in many cases, it's figment of imagination. So we clearly watered down that. We would speak to ex-employees, because that's really where you get a lot of information. We would do plant visits with experts, really to assess the quality of the plant, because that's the most important thing you're buying. What is the investment required to put the plant back to work? What is incremental capital you need to, technology has changed. The company has to be competitive. What further the company needs assets, the company needs to invest in to make sure they are on top quartile, like I said, in terms of costs, and the status and permits. Fundamentally, those are important to us, because once you take over, all of these will be the only factors which will matter. As we know in IVC, otherwise everything gets, at least on paper, washed out. Forensic is the other thing we do. We hire forensic agencies to go behind the scenes and figure out what really happened, how the stress got created, who are the vendors, who are related parties, so that we are aware of that. What is the potential labor issues once you take over? So one is completely prepared for that, especially when we do this in partnership. Environmental diligence is becoming very important. So we ensure adherence to the best ESG practices, where the outcomes are bettering the environment and the society. I think on the business commercials, we have a panel of industry experts across sectors. I think most funds have that, who either worked in the companies or visited the plants. So whom we work with, And then we work with strategic consultants to build the industry risk dynamics. All of that gets baked into a business plan and a 180-day turnaround plan. So that's how we approached both Binani and Bhushan when we bid for in IVC in partnership.
Right. So thanks, Shantanu, that helps. In fact, just to accommodate more questions, I will move to the next one, because this is exactly linked to this one with regards to access to information helps in price discovery. And it especially so if you can find it in a more structured way and more timely. Indranil, this question is directed to you. It all boils down to the value that is logged in any identified asset to ascertain potential investment opportunity. Turnaround strategies and eventual exit. Has value discovery, price discovery been easy, or is it muddled with challenges in India?
I think if you ask me, my answer is going to be that price discovery for the stuff that is traded has been reasonably good, right? And like everything, it's a function of demand and supply. The whole demand element goes to your sort of opening question, right? Why are investors looking at India? And there are lots of investors who like to do special sits and stressed and distressed who are looking at India. There are homegrown investors, both in the form of funds, special sits funds like my panelists here, or even the ARCs, right, who have access to some capital, which they put into situations like this. And given that there are so many market participants who are looking to transact in this space, eventually I feel most situations end up being competitive, and there are at least more than one player. There is at least more than one player looking at a particular situation, which helps in price discovery. Similarly, on the supply side, there are certain banks who've actually done a remarkable job of running competitive processes, right? I mean, I think SBI is one of them. They actually do a fairly good job of making sure that they run a process, get people involved and excited, and eventually get the best possible outcome for the existing investors there. So I think while there are challenges, and India is by no means a perfect market, and as I say, usually it takes 3 to 4 times the effort to do the same deal in India versus in the US or the Europe, but eventually I think price discovery has been fairly fair in the Indian distressed context at least.
Thank you so much. Rahul, would you have a quick view on this?
So I would broadly agree with what Indranil is saying, but for the fact that, so as there's a different set of investors who invest into distressed India, right? And if someone is having a strategy of buying a stack of debt, the entire pool of debt, he is also, the price which he is assigning to is linked with the time which he assigns, or the probability he assigns for the resolution of the distressed asset. Now, here is where the efficacy of the regulation, here is where the time taken under IBC for resolution of the asset, here is where probably the potential for surprises to come up comes in. And there have been certain situations where probably investor would have factored in certain time frame for resolution of the stressed asset, but because IBC is evolving regulation, it's taken more than expected, and probably that's where the investors have kind of not been very happy about it. Right. But broadly, otherwise, yeah, it's been reasonably good. It's only these surprises which make things a little sour.
No, absolutely, Rahul. Well said. Shantanu, my next question is on investing strategy. I am moving fast so that we'll move to the regulatory aspect. Shantanu, you have experience, and promoter NPL, while it may be relatively smooth to partner with promoters and management, and strategize turnaround while picking up assets at the pre-NPL stage. And in your experience, is it possible or even advisable to cut out the promoters entirely in an NPL resolution situation, considering Indian promoters fight tooth and nail and even stall picking up assets at times?
Yeah, I think if it's certainly in IBC, it will take its promoters will litigate either directly or through vendors. So that is something we need to bake in into the time we spend before we take over the asset. I think the question becomes more relevant. So obviously in IBC, once you take over the asset, the promoter is no longer engaged. There could be some ground level post takeover challenges which you'll have to fight your way through, but largely you own the assets. And as we've seen, assets have exchanged hands, over the past 4-5 years of the resolution which have happened in the country. I think the question becomes more relevant of outside IBC, and at least the view come to is you can't cut out the promoter outside IBC. So I would say there are two scenarios there. So if it's outside IBC, you like the asset, you're fine with the promoter, and it's all relative in the degree of in the scale of 1:10. But if you think that you're somewhere closer to the higher end of the scale, and you can believe in the promoter and the management and underwrite, then I think you could sort of take a distress to control approach here, where you exercise greater control so the asset doesn't go into distress. So control mechanisms like trust retention account, governance, cash flows, security, monitoring, all of that comes into play. But if you're not comfortable with the promoter, or if you don't get access to these controls, I think it's sort of difficult to play this with a promoter who is not reliable. And the only other option then is you buy him out and bake that into the EV value, which comprises the price at which you settle the debt and what you pay to the promoters. But I think, otherwise fighting the harder battle of buying the debt and then fighting the promoter out before taking control and fighting to the Indian court system, at least in our view, is not worth the efforts.
Fair point. Fair. Moving the needle to Rahul. Rahul, your views on this? What is difficult to fight? Indian promoter fighting tooth and nail, or it's a process that is smooth?
So, Jyoti, a lot depends upon what situation are you in. Are you in pre-IBC, post-IBC, or a pre-pack, so to say, while it is not yet come, and I wish it comes at the earliest possible, right? But if it's pre-IBC, you're looking to settle it, I guess, and if then I guess working with the promoter is the most desired thing. No point in going hostile. Ensure makes sense to work on a deal if you're comfortable working with. But if it's during IBC, I guess that channel is any which way is closed. And that's when the risk of the promoter litigating and all those things come in. But I guess we all have to face through that. And then you have to build in your capabilities, your expertise to run the company, to turn around and stuff like that. If you're comfortable, you take it up. But I guess it's not a situation where you would want to go deciding that, my intention is I like the company, but I don't like the promoter, and then let me just ensure he's out. I don't think it's the best way to run things. I certainly don't think it can work very smoothly in Indian context, and I don't think we are keen to walk that path.
Great, that's a candid view, and that brings me to questions that will be based on regulations. Nitesh, this question is to you. Frankly, is the existing legal and regulatory framework sufficient to tackle the distressed asset situation? And what are we asking for more?
So I think, in this context, I would just mention this comment I read by a senior tax practitioner. He wrote this comment in the context of the recent Mumbai NCLT judgment, controversial one. The comment was, I know the law is taking its own course, but I don't know where it's headed. So I think it was slightly sardonic, but it was apt in the context. And, taking cue from such comments and also taking cue from what was stated in certain judgments where, like this was Ribbon's judgment, where the judge has gone on to say that if a person cannot pay his debt within the within the grace period, then that person should not be eligible to be promoter, etc. So there is a sense that the law is going everywhere, but I think we should all understand that the present regime is actually a paradigm shift from what used to be earlier. I don't think anyone has heard of presidency or provincial towns insolvency laws outside of law school. BIFR, AIFR, we all know what fate the creditors had in BIFR and AIFR. So I went with, and obviously there was SARFACI, there is RBI prudential norms, but I think they are best playing a supplemental role. So when IBC came into being, with every new thing in India, there is some element of apprehension. And I think that apprehension was sort of cast aside by RBI by nudging the 12 bad debts and nudging the lenders in the right direction towards the 12 bad debts. So I think that was a very good move by RBI. Whatever happened to the circular is a different story. It was litigated in the Supreme Court. But I think that was a good hand-holding by RBI, and that led to a bandwagon effect, which led to the lenders queuing outside NCLT, and that in turn led to development of the law, which I think was very important. It isn't a hasty legislation, okay? It is a very well thought through legislation. Obviously, it's going to have its drawbacks. This is the first time India 2016 was the first time India was actually experimenting with a law like IBC. So a lot has been said about it. Even when the data is out there on IBC, I think the data presently reads there is some 350 odd cases that have been resolved, but 1,300 have been referred to liquidation. But if you see in value terms, the value of the 350 cases that have been resolved is actually 4 times the value of the assets that have been actually referred to liquidation. So I think IVC is in its nascency. It requires some amount of physical and psychological infrastructure from our end. When I say physical, I mean more NCLT benches. I mean more members. I mean more continuous education to all the stakeholders. By psychological, I mean the need to evolve dynamically alongside the law, especially the COC. The Committee of Creditors is the soul of the entire IBC process. So they need to evolve alongside the law. So I think what IBC requires is an optimistic analysis from time to time and not radical criticism,
Fair. No, fair, definitely. Rahul, you heard Nitesh, and we have heard the other panelists speaking on various aspects about investments and gains from the assets. My question to you is, you think the players have tendency to flip the assets at game instead of going down the tedious path of resolution? And if I may say so, has enough been done by the players? Rahul, what would be your view?
Given getting me into a tight spot. Okay, so fair. Jyoti, a lot depends upon the profile of investor. Okay, if it's someone sitting outside India who is just looking at the Indian opportunity set, I think it would be unfair to expect that he comes and does all the stuff that's needed to be resolving it. But I guess he's also playing a reasonably good role. He's ultimately providing an exit to the existing lender who is holding the stressed asset, and to that extent, he's releasing his capital and liquidity. So I don't blame him for that, right? Now, a question comes in: what happens to the guys who are expected to play the role of pure play resolution and resurrection? Is that being done? So the whole sort of set of investors out here. There are ARCs, AIFs, there are strategics, whole sort of them. I mean, it's best to keep strategics aside because they have different, they are perpetual investors. That's the way I would want to call them. And I guess we have seen a lot being done by them than by financial investors. And I guess AIFs, the category which I belong to, we are new kids, let me tell you. I mean, if we talk about Indian context, we are relatively new kids. And historically, it's been ARCs. And I've not seen much of resolution happening out there. Obviously they have helped the system in the sense that banks who are holding the stressed accounts, they bought it from them. But several times we have seen invariably, they would invest 5 or 15%, but balance 85 or 95 would be held by the banks in the form of SRs. Was it a true resolution? In my view, is no. So that's what the situation is. Yeah, so there's all sort of people who are buying to flip it over. Some people are doing stuff to resolve and stuff like that. But I think, for a true resolution, what is needed not only is, you give an exit to the existing lender, but also you should have enabling provisions and the dry powder enough to put in additional capital, which is needed for resurrection of the asset, for ensuring it grows. Because when an asset is not performing, even if you buy the stock of debt, you resolve it, but the funding from the conventional sources is not going to be available. And that's when the incoming investor is supposed to be putting additional capital to ensure, enough growth capital, whether in from working capital debt or whatever is provided. And I think we've seen a good amount of activity done by AIs on that front. But I guess we have a long way to go. That's my view on it.
Right. Thank you, Rahul. You did not nudge the bullet. You went all in. Great. Good to know. Shantanu, Indranil, would you have a point for this, especially when we see things around? Do you see that the players are literally flipping the asset at gain instead of going down the tedious path of what is to be done. Shantanu, your quick word on this, please.
Yeah, I'd just like to say that there's no easy way of making money in life. And especially if you go with the portfolio kind of approach, which Rahul mentioned, very often the outcomes are not in your hand. How the courts behave, whether consolidation of debt will happen, the resolution timelines in IVC, those are uncontrollable factors in my view. So, it's obviously every investor has a different strategy. So given a choice, given that we have a infrastructure in India, we got a team in India, we would rather like to focus on things where we can, influence the outcome and put in the efforts and get the returns.
Right. Well, thanks, Shantanu. Indranil, your quick word.
Yeah, I think same, right? Going in, most investors of our nature, are going in with the intention of providing capital and being invested in the business for anywhere between 3 to 5 years. So no one really goes in deciding to sort of flip very quickly. Also, one has to look at it in the context of India, where there really isn't any meaningful secondary trading of, distressed credit as such, right? Maybe once in a while, these credits change hands. And, in some of the large dirty dozen cases, there was a little bit of trading, SR, Bhushan, etc. But outside of that, it's fairly few and far between. And if something suddenly changed that an investor can flip it, right? And when he's flipping it, I'm assuming if he's flipping it quickly, it's at a substantial gain. Then I think the investor is well within his right to try and take advantage of that situation and exit. Like Shantanu mentioned, it might be a one-off instance, and anyways, the rest of the portfolio will be sort of a hard workout type portfolio. So if once in a while an investor like us gets an opportunity, then I think there is nothing wrong in grabbing that opportunity.
Thank you, Indranil. We are moving to the last questions on the regulations, and then we'll open up the question bank for the bad banks. So Nitesh, this one is to you. Is it time to adopt debtor in possession as opposed to creditor in possession approach by doing away with S29A of IVC? We spoke about IVC regulations a while back. Do you think this will augment collaboration and turnaround management between rescuers and promoters, and thereby promote timely resolution and recovery? Is pre-pack the way forward?
I think definitely yes, and I would expect the panelists also to agree with me on this. 29A, the code never really envisaged 29A to begin with. It was brought about in 2018, wilted down in 2020, and its constitutionality, etc., has been challenged from time to time. The code has upheld the constitutionality. In fact, it's in the same judgment that I just mentioned some time back, Swiss ribbons. But I think what has happened, I think if you look at it even from a social perspective, there is a pejorative or a stigmatizing value attached to insolvency in India, right? And I think the whole concept of 29A perhaps stems from there, where you indeed, if a promoter has led the company to insolvency, the promoter is most definitely going to be culpable, right? I would not think of it like that. I think there are several dynamic factors attached to it. And even if we do not intend to completely do away with 29A, I think we should adopt the pre-packaged approach that we have now, and we should apply it largely to the entire IBC regime. I think it's going to take some time. There may be some objective criteria to apply it to certain set of companies and not to certain set of companies. But I think that should be the better way to go. I think pre-package will be the guiding light in the sense that pre-package is a good mix of creditor in control plus debtor in possession, where you have an IRP also overseeing the entire process. And I think that is obviously going to augment some kind of interaction between the promoters and investors.
Fair point. Absolutely. We are moving to the last but one question. Rahul, this is for you. To begin with, the systematic mishaps that have occurred in the NBFCs and the credit mutual funds industry have only paved way for more distressed assets, which are up for grab. Do you think there are learnings from these mishaps? And for the private credit sector,
Yeah, I mean, I think this was the starting point, so to say, for the current set of field in the stressed market. So we all know it started from ILF, so probably a little prior to that, when the most high-profile borrower GSPL defaulted somewhere in 2017, if I'm not mistaken, right? And then the NBFCs faced liquidity squeeze. Mutual funds were the largest, NBFCs were the largest, investee sector for mutual funds. In turn, that populated mutual funds, and then it kind of became a full cycle. Now, if you see what was the central issue out here, it is classic ALM issue, asset liability mismatch issue. Whether it is a ALM issue at the end of an NBFC, whether it is a ALM issue at the end of mutual fund, whether it is a ALM issue at the end of the borrower, or whether it's a ALM issue at the head of the promoter. We saw mutual funds and NBFCs funding, the promoter part of the equity contribution basis certain liquid securities. And the promoter happily got it because he was getting a single-digit borrowing to meet his equity requirement. We saw, in project debts, the sponsor commitment was met from NBFCs. Obviously, all these are really long-tailed assets where the cash flow comes in much later, or probably you're trying to substitute dilution of equity. Now, so long as the party was going, it was great. When it stopped, it hurt everyone, and which is what we saw it's happening. So as a result of it, we saw there were several measures taken all across regulations. And to quite an extent, it's been good. If you see for last year or two, we have not seen that kind of euphoric or mispricing of credit happening, so to say. But again, we live in markets where memories are very short. Once person starts chasing yield, it will be interesting to see how things pan out, right? But I think on a regulatory front, several things have to be done. Now, us as participants in different investor categories, we have to be more disciplined. Else, when it just falls, it pulls everyone down. So it's a lot on us, and it's that classic thing. Government has taken out the restrictions. So second day, everyone is out there in market shopping. It's not that coronavirus is gone, right? So we should not replicate that mental psyche. That's the way I will look at it.
Right. So thank you so much. This is literally one of the learning is be more disciplined. Don't just go all out. There are regulations.
And a sense of your own asset liability. Everybody should have a sense of his asset liability, and what should be funded through what should be seen. Absolutely. I think that will sort out a lot of things.
Absolutely. I am in hurry to come to the bad bank, and in fact, in the context of mishaps and learnings, I think my last question is going to be most apt: the bad bank. So, do you think, Nidesh, this question is to you. Do you think bad bank is likely to take a large chunk of distressed assets outside the purview of the IBC? Do you see that happening?
See, possibly. I mean, I'll just keep this answer quite crisp, and I'll let the others also chip in on this. I think that could be a possibility. My only fear is that it's going to be private transaction between. It's going to be set up as an ARC, and it's going to be private transaction between bank and ARCs. From what I read so far, it appears to be outside the purview of IBC. My only fear is that it should not, dilute down the substantial chunk of jurisprudential development that has come in IBC. That is going to be a bubble. And on a lighter note, I would want IBC to survive and go the way it is, because we are lawyers and we also need to make some money. So I quite like the way IBC is going so far. So.
Okay. So Rahul, how do you think it will impact the availability of policy?
I don't see much of a challenge out of it. As Chandran said in the first answer, right? There is enough for everyone. There's 200 billion, and at the end of it, the bad bank is also needing. It's more of aggregator the way I look at it. If anything, it's going to help ease the process and the issues involved in decision making. Now we as potential investor are going to be dealing with one counterparty, and it will probably help us. So I look at it as a positive. That's that it should ensure level playing field between the existing ARCs and them. And it should not, if that is not ensured, then it will tilt the balance. It will make the market dynamics go haywire. That should not happen. That's my only hope.
Right. So certainly everybody has its due share from the segment that is growing. Indraneet, my next question to you on bad bank is, just like a bad bank, do you think a private public partnered fund at national level is possible in India? Can such a fund with private sector expertise help salvage the distressed asset situation?
Yeah, I mean, hypothetically, yes, it is possible. I think the biggest question for such partnership will be governance, right? And as long as there is a mechanism to ensure that governance is going to be efficient and commercial, I think, yeah, it might be a good idea.
Lovely. So that's a thumbs up. Shantanu, this is the concluding question of the panel discussion, and you are the lead here. Do you think bad bank will supplement IVC or render it redundant in the due course, at least so far as the financial creditors are concerned? Shantanu, your views, please.
Yeah, thanks. So IVC, I think, is here to stay, firstly, as a go-to enforcement platform for lenders and investors. I think we are hoping that over time it will become more efficient. It's currently, can you hear me?
Yeah.
Sorry. It's got currently a lot of challenges, but hopefully over time it will become more robust. So in my view, bad bank will supplement IVC. Also the way we as investors will look at, as let's say I put money in an asset, if bad bank is not able to consolidate the debt or catch assets early, that's also equally important. Then for us also as investors, we'll prefer IVC as a route, assuming I'm in an enforcement kind of a situation, But I think if the bad bank is implemented properly, which means that it's able to consolidate, it's able to establish transparent pricing mechanism for investors to invest in, then I think IBC will also supplement it, because there'll be some assets which may need to go to IBC for cleanup, where contingent liabilities get washed out. The contrary to that is if bad banks ends up buying a lot of assets which are unproductive, which are typically shut capacities because it's been shut for long, it's no longer viable, then the bad bank anyway has to use IBC to go into liquidation. So either ways, I think IBC is there to stay and also make money for you guys.
Wow, lovely. That's money for all, investments, opportunity for all, a message from the industry veteran Shantanu. We have lots of questions coming in from the attendees. I'll take a few of them. And please mention who would like to take it. What is the bigger opportunity in India? Distressed debt, that is NPL purchases, rescue financing, or distressed equity, that is buyouts and turnaround? Who would like to take this question, please?
I don't mind taking it up.
Okay, Rahul, go ahead.
So, if I look at it, for me, distressed debt and distressed equity, both is the same, right? If the opportunity is great, I guess we would want to look at a situation where I can have equity around it, okay? And run to a situation, take it to a situation where probably, I realize the sale of it and make money out of it, right? And especially if you're partnering with the current promoter, if there's no value in the equity, I'm sure he will ensure there's no value left for your debt as well. So whether you are taking equity or not, you have to look from a holistic perspective. So I would not want to box them into two different categories. That's the way I look at it.
Fair. My next question is, we have run out of the time, but I'll take the last question and I'll urge audience that we'll respond to the ones that we haven't answered, and you will receive an email from us. My last question for this session would be, is there enough track record for distress investing strategy, so to say? How can we say that the strategy works? So in short, what has been the strategy runway experience of in the Indian market? Yeah, who would like Shantanu in the reel? Who would like to answer this question?
I think the reality is it is a nascent industry, so it's close to. There have been funds who were there before, but really the mechanism which has been made available, IBC, and I would like to call IBC as either an enforcement or like a deterrent, and along with the RBI and the government moving decisively towards recognizing NPL and forcing banks to sell their assets, is just close to 4 to 5 years old story. So I think it's a nascent industry, but it's promising. I think, with credible players like my peers who are there on this panel discussion today, we all bring in great international expertise with local team on the ground and network. So I think, I for certain remain very optimistic that, this distress investment in this country not one cycle, but is here to stay for long.
Jyoti, just to quickly add that, while the distress investing which we are seeing, the magnitude and scale of it is very recent, thanks to IBC. But I feel this is a long-term play, and my belief comes from the fact that, not many would know that Kotak, we have been into distress investing for 2 decades. And earlier, we would be investing out of our balance sheet, out of Kotak Bank's balance sheet, where it was a dedicated business module where we would buy NPAs, we'll resolve and sell them, or resolve, and that's it, that's it, just get it. And I guess over 2 decades, we have had phenomenal experience, and the return number that have been talked about, the numbers have been far better than that. So obviously the scale was much smaller. So I get a confidence from the fact that, now that the regulatory environment is more conducive, there are more tools in the hand of an investor. I think this is to be there.
Fair, absolutely, definitely. Indranil, you are backed by a foreign large institution yourself, investing in distress space, and you have the runway of experience too. How do you look at your international investors looking at India? As I said in my initial discussion, that the space is nascent, it's still evolving, and look at the traction that we are witnessing. How do you see the strategy experience of investments in India? How do your people respond?
It's early days, as Shantanu mentioned, and I think one of the things that international institutional investors are focused on is establishing presence in the early days of what is surely going to be a fairly successful and large segment of investing in the Indian private or alternative space, right? So that is one of the added reasons why global investors are focused. They feel whatever little we've seen of IBC in action, it's gone through several sort of changes and fixes, but that happens like any software. You need to upgrade and bug fix it. But with all of that, I think the experience has only been incrementally positive. People in this short duration have, been able to get exits and significant returns, and IRR thresholds are being met. And hence, I think the global stressed and distressed investing community remains fairly keen on looking at India as a destination.
Fantastic, lovely. We have actually come to the close of our interactive session. It was indeed very interactive. There are questions that are still to be answered. I'll take care of that subsequently with help from all of you. I would like to now profusely thank the audiences that joined us today for this specific talk. Definitely to our speakers who took time out to be amongst us to answer these questions. So I'm firstly very thank you for that. Most importantly, events like this needs a lot of behind the scene coordination. I profusely thank IVCA for a phenomenal platform they have built up, and IC Universal Legal for joining, for supporting this initiative for the audience. And it's important to thank all the team members that came together to put this together. Shreya, Sumit, Akriti, team of Nitesh, and so many wonderful colleagues of mine and at IVCA. So thank you all. Thank you, audiences who have joined us from different geographies today and stayed us beyond 60 minutes. Thank you, speakers, for spending your time with us. And trust me, all of you are doing a lovely heavy lifting. You're putting India on the global map. So all the best. And let's keep tirelessly working towards making India the robust market that it is. Thank you, everybody. Thank you so much.
Thank you, Jyoti. Thank you.
Thank you. Stay safe, everyone.
Thank you, Shantanu. All of you too. Bye.